Okay, welcome everyone to the global market outlook for November 2021. As usual, we'll be going through the managed portfolio, what moves that we're making, and just the general news and events that we've seen this over the last month. The big shifts in the market outlook. What we're going to be chatting about is a little bit of the moves that we're making. There's a couple of unbundlings and that kind of thing. Let's get started. Before we start, as usual, I just want to take you through what the business does and how we operate. Normally, at least we run a couple of different businesses: online trading, private broking, managed portfolios. Those all form part of our stockbroking businesses. Structured products, that's something Viv takes care of. It's kind of a medium risk financial product, generally credit notes with some sort of defined payoff profile. He does offshore, at least we do offshore transfers as well. A lot of our client assets sit internationally. We probably sit with about 85% of our assets internationally currently. So that's just, it's a kind of a subsidiary product that just helps you move money in and out of the country. We're going to take a look at currencies today as well, so that you can just get a sense of where we see the rand dollar at the moment. Wealth management, really headed up by Yaku. There's a very holistic view of client portfolios, generally deals with compulsory money. It's all the structuring. Do you need to create trusts in Guernsey? What do you need to do to achieve your financial goals? And that obviously includes needs analysis and a lot more than is normally involved in traditional securities broking. And tax-free savings accounts, which is headed up by Varma. Very, very simple, very nice product, nice tax wrapper, but you can unfortunately only do 36,000 Rand a year into those products. But something that we believe every client should have, and it really does form a building block of any wealth strategy. So we do put a lot of focus on it, even though it is essentially a pro bono product for us. We do all our tax-free savings accounts for our clients for free. We have a nice little managed option as well, which I must actually include in one of these presentations because it is typically forms under a part of managed portfolios. What is this specific presentation about? It's really to service our online trading clients. I know you guys feel like you're left in the dark. You guys are making the decisions yourself. And often, I suppose you don't have the kind of information that we have access to. So I want to kind of share that information as much as possible. It's also for clients that are in our managed portfolios. That's why I specifically talk about our global managed portfolio in this one. If you have money invested with us, you want to see what's happening to the underlying securities. You want to see how we are thinking about markets at the moment, and make sure you still agree with our strategy going forward. Of course, it's open to everyone, so this isn't closed to clients. We don't, unless you register, we don't make these publicly available on social media and that kind of thing. So it is designed more for existing clients, but if you're not a Randstad client, you are welcome to join. And of course, our private broking clients generally, you might join these, you might not, but you've essentially got your own private dealer, so maybe you're getting your information that way. Why should you listen to us, and who are we? Many people on this call know that we've been very focused on trying to create an awesome business. It's never really been about the money for us. When I say about our money, it's about your money. So it's about us delivering an excellent service to you guys. We won the overall award in 2019. We came second in 2020, but we're back on top now. We collected 3 more awards at the event last year, which puts us as the #1 broker in South Africa, which I'm really proud of, because yes, we want to scale our business, we want to generate more clients, we want to bring in more capacity so that we can service you guys with new research offerings and more portfolios and more products, and really just try and give you everything that you guys need to be really, really happy. But at the same time, I'm not prepared to grow the business if we're going to sacrifice quality at the expense of quantity. So it's always been about very measured growth in our business, and one of the ways that we measure our growth is how we perform in these awards every year. So as long as we're top, I feel comfortable to kind of start pushing the business for growth a little bit harder. But very, very happy with that. And we really did. We kind of scooped a whole lot of different awards last month. Top tax-free savings account, top firm overall, and the People's Choice Awards was really voted for by our clients, which, I mean, we love you guys, and thank you so much for the support. It makes a difference. And yeah, hopefully, you know, we can use the platform that Intellidex is giving us to try and leverage the business into bigger and better things, which is always key. Okay, so on to the presentation for today. I'm going to stick to the same format that we normally go through. I'm going to have a look at what's happening in the global equity markets. We're going to look at commodities, we're going to look at currencies, and then we're going to look at the managed portfolio and what moves we're making. Specifically, we've just gone through earnings season, so there's a lot of corporate news to go through, and there's a couple of things that are happening within those managed portfolios that you need to be aware of. But we'll cover that in section 4, and then of course we always open the end of the presentation to questions. So if you have anything, I mean, feel free to ask as we go through. I mean, you can just pop them in the Q&A tab. You can pop them in the chat window. I'm probably not going to answer them as we go through, but I will answer all the questions then at the end. So if you think of anything and you want to put it in, just stick it in stick it in the Q&A or the chat. Okay, so global market overview. What happened over the last month? So it was interesting. So when we chatted last month, we were going through a down period, and it's a time where I said this is an awesome time for us to execute new funds. So we really have been stepping on. We stepped heavily on the pedal. We deployed a lot of new cash for client portfolios over the last month. If you're a new client that has just been deployed, I know a lot of new clients join these sessions as well. You'll probably see in your portfolio a whole lot of security started moving in there. So we normally take 3 to 6 months to execute, because we believe in timing. We believe one of the key benefits of having a personal share portfolio is that you don't have to buy a unit in a unit trust to get all your shares smashed in at the same time. You can time your entry, and you can buy undervalued companies. And yes, it might be in our managed portfolios, in our model portfolio, but if it's looking very expensive, we have no problem waiting a couple of months to see if there's a bit of weakness that we can buy into for you instead. So we do normally staggered implementations. We also offer clients the option to do a bulk implementation as well. So if a client specifically says, just push me into the market quickly because it's the middle of coronavirus and I just want to get fully exposed, that's of course your choice. That's the beauty of personal share portfolios. They're incredibly flexible. But as I said, over the last month in September, very, very big down month. Part of it was a commodity collapse, which is what pulled South Africa down to 8% loss in September. We've seen a big rebound in financial markets across the globe, and I'll show you a little bit more of that when we look at the VIX chart in a second. The rebound has been pretty swift and pretty strong. At the moment, you can see that the US, which was down around 4% last month, up 7%. So that the tech stocks are really driving the rally that we're seeing. We're seeing also a nice kick up in Europe, which is great for. We've got a lot of structured products that we linked to European indices about 2 years ago. A lot of those auto call products, if you've been a client for a while, we've got an auto call cashing, which was a local auto call, which is now going to cash because of the European performance. Clients, they were linked essentially to the European market, which over the last 5 years, we're going to have a look at that in a second. So I've got a European split up, but it hasn't done particularly well. Yet clients are going to now get basically a 40% return in 2 years thanks to that auto call product. So that's just an example of a structured product that we've done. But Europe comes to the fore, really being driven by France, which is interesting, and we'll see that a little bit more. So this is just the 1 month performance. You can see South Africa, unfortunately, not kicking back up, and so much of that has got to do with the slump that we've seen in commodity prices. We've got very strong results out from MTN, and that's helping drive that share price. That was up over. So I've got a screen up here. That share price was up over 12, 14% at one point today, up around 8% now. And MTN is a key holding, along with the likes of Richemont and Aspen in our local managed portfolio. But yeah, South Africa, again, the commodity stocks just not playing ball, so not seeing the recovery in South African markets currently. If we go to a slightly longer term view, normally I just do monthly and yearly, but I'm going to look at a 5-year chart as well. You can see that the pattern that we've been seeing over the last year is still very much intact, but we are seeing a little bit of a recovery in China this month. So over the month, we had China up almost 6%, but over the last year, China's still down around 20%. Japan, struggling over the last year as well. But as I said, the real kick up in the last year has actually been Italy and France. So it's been the European markets that have actually outperformed the US markets by 6 or 7%. So Europe looking pretty strong after the little push up that we've seen in the last month. But that divergence is still very, very clear. Chinese markets still under a lot of pressure after all the regulatory changes and all the regulatory announcements that we've had in China, just cracking down on everything from antitrust to data security to private tuition. The Beijing really, really concerned about what's happening in China. So at least what's happening within their listed company space, that obviously feeding into this dollar-based market performance, and China under a little bit of pressure. We have seen some indications that the value players are moving into China. The likes of Charlie Munger is buying in. Warren Buffett's partner, he is 97 years old though, so I don't know how much you can read into that. But a lot of the big value investors are starting to look towards China as a play. I still think there is opportunity in China from an equity market point of view. It is obviously a much higher risk jurisdiction, but and there are, I suppose, economic and demographic problems in China as well that you've got to be cognizant of. But given the recent sell-off, I think a little bit of a relief rally might be on the cards. So I think there might be a couple of opportunities in China, maybe not for our managed portfolio, but for those with a slightly higher risk tolerance, that could be something to have a look at. If we look at it over the last 5 years, so this really has been I just wanted to give you guys the trend of the last 5 years as well. Again, all of this is reduced to constant currency. So this is the performance of all the different countries, well, not all of them, but a selection of countries' markets, rebased to dollars. So the US up almost 120% over the last 5 years. South Africa essentially flat. We're only up 5% in dollar terms. So while our all-share index has done very, very well, it's only done well in rand terms. And obviously with the weakening currency over the last 5 years, your dollar-based performance when compared to all the other economies has actually yielded a very, very poor return in local markets. Now, that's, if we look at that, there's a big difference. Why is the US on top? Why is South Africa on the bottom? Let's look at the underlying economics and what's happening from not a financial market point of view, which is essentially securities that are priced based on future expectations. Let's look at the history of what is actually happening in these economies. And by that, we go and look at the economic indicators that sit in the different economies. So this is just a quick picture of the US economy. I picked 4 key metrics. The first is the inflation rate. Now, this, remember, we've just gone through, I would normally do a coronavirus slide. I've actually taken that out. Coronavirus, as we were talking about last month, my feeling on coronavirus at the moment is that with the vaccines being rolled out, yes, we're going to have new variants. Yes, we're seeing the UK struggling with its new variant. But the point is that from an economic point of view, we have to get back to business as usual. The idea of us going into hard lockdowns again to try and counter the virus is not going to work. And with the vaccines, we are in a new world. There's no question about that. But it is a world that I'm doing this webinar from my house rather than from the office. But we're not doing a presentation in person. But I think economies around the world are starting to work out how to adapt. And remember, in a market system that essentially the global economy operates in, it is very resilient to these kinds of shocks. Humans, we sit, we work things out, we make a plan and we move forward. So yes, coronavirus is an issue, but I've kind of taken that slide out because from now on, I'm kind of putting coronavirus from a financial market point of view in our rearview mirror. I don't think coronavirus itself is going to be the cause of another stock market collapse. It might be a cause of a big change in economic indicators, which is what we're going to talk about now. But from a financial market point of view, I don't think it's as relevant as it used to be. So that's why I've removed the slide. But in terms of the annual inflation, this is one of the impacts that coronavirus has created. You know, we've got all this chaos in supply chains currently. Okay, could you add Australia to the world charts? Yeah, absolutely. That's a great point. Thank you. Yeah, we'll actually add Australia to that because especially because we're in the process of building a mini Australian portfolio for some private clients. So that will actually be a nice one to track in the monthly meeting. Thank you for that. Yeah, annual inflation rate, yes, is ticking up. Now, part of this is the supply chain disruptions. Part of this has just been because of the punch that the system has taken. And it's going to take time for that to get back. Now, obviously, if you're a Fed watcher, if you watch what central banks in the US say, you know, all of this is just transitory. They're saying, oh, look at the kind of prices that we're seeing in used cars, for example. You know, yes, we shut down production at you know, big car factories, so there isn't the stock of used cars coming through. So used car prices are rising because people either can't buy new cars or the new cars, you know, are becoming old cars to be sold. So, you know, of course, prices are spiking, but, you know, the system being what it is, when prices spike, things become more profitable. You know, the quantity, the supply will catch up because if the demand is there, the supply will catch up and prices will normalize. Now, that's been the Fed's tone for a long time. But you do get the sense, like even with the latest meeting that we looked at, there is the sense that the underlying economy, the underlying inflation is going to be a little bit more sticky than people originally thought. So we've had the inflation rate ticking up quite significantly in the US. It stayed elevated. The Fed has promised that it's transitory. They've kept monetary policy ultra loose to try saying we don't essentially need to combat this. Part of that was because I think they didn't want a panic, but we have now obviously had the idea that tapering is beginning. So the Fed has come out and said, oh, listen, yes, we still believe inflation is transitory, but we are going to start reducing that aggressive stimulus package, you know, that bond buying program. It doesn't mean that the federal funds rate, which is at the bottom right-hand side, is going to increase. You're still you're still stuck on the zero bound. You know, they are not lifting interest rates. What they are doing is they're scaling back their bond purchase programs. So in November, we're going to see 10 billion a month being removed from the treasury purchases and 5 billion a month being removed from the mortgage-backed security purchases. So we are seeing a slow unwinding of stimulus in the US. We have seen, I haven't got the developed market charts up this month, but we've seen that, you know, all sorts of emerging economies are already starting to lift their interest rates. So we have started as a globe our tightening cycle in terms of monetary policy. One of the reasons we're starting that tightening cycle is because of the elevated inflation. It's yes, we're seeing a rebound in growth across the planet, but it seems very different to me from when we started out, you know, essentially the tightening cycle when we had the first taper tantrum after the 2008 crisis. The sense is very different. There we have very, very strong growth numbers coming through. And as you said, yes, we get the strong, you know, when growth totally collapses over the coronavirus, and then you get the big rebound in growth following, you know, the reopening up of economies. And you get kind of like these skewed numbers for a little bit. We did get a miss last month on the GDP growth. And there is a sense that economic growth is still a little bit tough. The economy is not right yet. And that puts us in a little bit of a different situation, you know, to the past. Generally, you know, there's a big debate on our desk at the moment whether rising interest rates are going to derail the recovery. And it's an interesting one, because if you go and look at the correlation between the rising interest rate environment and stock markets, you know, technically, yes, higher interest rates make the cost of capital more expensive. It makes kind of bond products more attractive. It makes, you know, kind of risk-free rate more attractive. So people don't have to move into equity. So it should be negative for equity markets. That said, normally what happens is people, or at least when I say people, central banks only start tightening monetary policy when they feel that the growth rates are robust enough to support, to not damage the stock market. So there's kind of like this to and fro on our desk on how this is going to play out. But at this stage, I do get the sense that it's slightly different. That said, The reason for the tightening is almost certainly inflation, because these days, remember, central banks generally have dual mandates. In the past, their mandates were very much inflation-based. Now it's inflation-based, but it's also got a growth component to it. So, with inflation high, they've got to protect, the value of the currency. So they will start tightening. What you're seeing here as well is the unemployment rate. Now, this is one of the things that's feeding into that higher inflation rate. So the shock to the system that we've seen in the US, and this is one of the reasons I love US companies, and I always tell the story of how Disney handled the pandemic with the furloughs compared to how South African companies had to handle it. They got, it's a wonderful story in which you can kind of furlough and fire all your workers when you're in trouble. You protect the business, you protect the cow that is making the milk, you keep that alive, and then when things get a little bit better, when the regulations change, when we got through the pandemic, essentially that business still exists to rehire all the people. And what happened is the Americans protected their businesses at the expense of their workers, and they allowed the government to protect the workers in this very odd situation that we have. What that resulted in is businesses being very, very robust. And as I said, we've just gone through earnings season, and you can see how well US companies are doing. What that allows these companies to do is rehire all those employees. It allows them to expand, and that's why you've seen this unemployment rate absolutely just screen back towards the frictional rate, which is, it used to be about 4% was the frictional unemployment rate. If you listen to Jerome Powell at the moment, they believe the frictional unemployment rate is probably 3 to 3.5%, just because of what they achieved before the pandemic. But we're definitely getting there quickly in the US market. Now, one of the things that happens at full employment, you start getting wage push inflation. Now, that is happening already, and there's stories we're chatting about it in our investment committee meeting yesterday. There are stories of McDonald's workers literally flipping burgers and getting paid $1 million a year in the US because they have to. There's just no option. There's not enough labor available. There's a labor shortage in the US. So salaries are starting to increase. If salaries start to increase, salaries don't come down. It's a very sticky form of inflation because a wage is just a different type of price. And as those prices increase, they generally tend to stay elevated. Consumer prices can come down from everything from technological changes to many reasons to commodity prices can come down. Your raw inputs can come down, which can put deflationary pressure on a system. But when wage prices go up, you've got inflation in the system, and sometimes it's very difficult to get that inflation out of the system. Our base case at the moment is that, yes, we will see inflation the inflation rate starting to moderate in the US, but it's going to run at an elevated level for a protracted period of time. That's been our case all the way through, and it seems to be panning out. We never bought into the transitory argument, and one of the things that we've been doing in our portfolios because of that is switching from these high growth stocks and starting to look at the more traditional, more reasonably priced value plays. One of the reasons is when you start tightening, if you start tightening in a cycle where growth isn't strong, you are going to see expensive stocks getting hit very, very hard. And the kind of growth versus value debate, which has almost fallen off the table because for the last 10, 15 years, growth has just performed so well compared to value. I believe should be put back on the table. You should be looking at more value-orientated stocks at the moment. Now, this is a kind of a multi-decade theme, and whenever you invest in equities, you should be looking at a 5-year plus time horizon. But with that idea in mind, it's not something that you have to run out and hit the red button tomorrow and switch everything into value. But to maintain a value slant in your portfolio is very, very important, in my opinion. The kinds of portfolios that are fully growth portfolios that have everything about 50, 60 PEs, all sitting in tech stocks that have done exceptionally well. You would have shot the lights out over the last 5 to 10 years. I don't think that that's going to be the case over the next 5 to 10 years. So just an element of caution. That's what we're getting off our desk at the moment. And at the moment, remember, we're neither value nor growth investors. We look at companies on their own intrinsic merits, and we try and get a value and growth skew in the portfolio so that we have both value stocks and growth stocks, so that you've got a nice mix that allows you to be fairly stable. It's one of the reasons that if we pushed hard into growth, you would have had better performance. But what the value it generates for you is a much lower volatility on your portfolio as well. It takes out a lot of risk. And when you go through a big systemic shock, your portfolio isn't going to come down as much because the if you look at what happened to Microsoft in the dot-com bubble, Microsoft's earnings almost doubled over the full dot-com period, yet its share price halved. So the earnings were increasing, but it's not earnings, it's revenue. So its revenue, I think, doubled over the 2 or 3 year period of the dot-com crash, but the share price halved because it was just an unwind of the multiple. It was just people weren't prepared to pay that valuation for a company like Microsoft anymore. So just remember, these might be great businesses, but just, if you look at something like a Tesla, it might be a fantastic business. It might be a great management team, might be a great story, but when it comes to the real shock that could potentially be around the corner, and you don't know what's going to cause that, to have that value component to the portfolio, I believe is very important, especially given the mandate that I manage to, which is to essentially protect people's nest eggs overseas with their emergency money. It's, hey, I don't want everything in South Africa. I live in South Africa, but I have a couple of million or whatever it is sitting in an international portfolio, generating slightly better growth, but something that I want outside of the South African environment. For me, I have to have value and growth in the portfolio. There's no way that I can go with a full growth tilt. But that's kind of the US. Now, if we compare that to South Africa, normally we manage a lot of different portfolios, but that's just the one that I'm talking about specifically today, which is the global equity portfolio. This is the South African economy. So if we go back here, this is the worst performer over the last 5 years versus the best performer on this list. We know the problems in South Africa. We have one of the highest Gini coefficients, so we have a huge gap between rich and poor. Much of that is the legacy of our history. But looking at the inflation rate here, we are essentially moving into a period that is very similar to what's happening in the US in terms of inflation. Now, remember, South Africa is a small, open economy, so we will import a lot of inflation. If oil prices go up, we're an oil importer. That pushes up the price of our goods and services. And we might not be having wage push inflation, but we are, we import TVs, we import a lot of stuff. So it will feed into consumer price index, it will feed into the cost of goods and services, and that will increase. At the same time, our central bank, which has been very, very, I look at the South African central bank, and I think out of all the government institutions, it's been probably one of the most responsible, if not the most responsible. They are delaying heavily on increasing interest rates. South African repo rate is still flat. Many of our emerging market peers have already started to tighten. We are still within our 3 to 6% target band. I mean, Lesotho Kanyako has been talking all about moving the target band as well. It probably will happen. It might have already happened, but essentially, we are in an environment where our monetary policy is remaining accommodative for potentially a little bit longer than it should be, but you can understand why as well. Our growth rate is incredibly bad. We can't move to a 3, 4, 5% growth rate, which we so desperately need to create a solution to unemployment. But because what is it? Correlation doesn't always imply causality. So if you look at the unemployment rate in South Africa, yes, a high growth rate would solve our unemployment problem. You hear that rhetoric from politicians all the time. We just need growth and our unemployment will come down. If you just had employment, you would also create growth. The real problem is neither, one is not going to create the other. The problem one of the major problems that we have is Eskom. I can't see our economy doing well until we solve our power crisis, and I can't see the end of that power crisis anytime soon. So South Africa, in our opinion, is still going to remain subdued for some time. That's it. We do manage funds in South Africa as well. Why do we manage funds in South Africa if we don't have an optimistic outlook on the South African economy? Now, that is interesting. So I've put 2 extra slides in here. So one of the reasons is, and it's one of the reasons that we do it as well, is because most of our clients, in fact, most of our clients, not all of our clients, but most of our clients are South African tax residents. Actually, I'm saying almost. So yeah, a fair amount of our clients are South African tax residents, which means that you are, if you're a South African tax resident, it means you still got to pay tax in South Africa, which means that there are advantages to having local investments from a tax point of view as well. As I said, a tax-free savings account, you can have that 100% offshore exposed through something like an S&P 500 ETF. Our managed portfolio is 100%. It's got an emerging market component to it. Our managed TFSA, but essentially most of those funds are sitting offshore. Basically in an international property ETF combined with Europe, Asia, and the US, and we kind of, it's basically got 5 ETFs inside it, and we kind of tweak the dials on the ETFs depending on what our macro view is. That's how we manage those TFSAs. But that you can be 100% offshore. But if you have retirement savings products, and you're below 55, those retirement savings products have to be essentially a component of them. 75% of them have to be, 70% of them have to be local. And because of that, there is a need for local investment. At the same time, our market also has, you guys talk about the SA Inc. market versus the Rand hedge market. So remember, a lot of the listings on our local exchange as well are international businesses. Richemont has almost no presence in South Africa other than the listing, just because of obviously the Rupert family heritage. You look at something like British American Tobacco, you look at something like AB InBev, you look at something like, weirdly also a lot of the commodity companies do act like Rand hedge stocks. So there's a way of getting yourself this international exposure and exposure to international trends and markets without needing to ship money offshore. Now, what that allows you to do is also put it inside wrappers. So you can't buy stocks directly in a tax-free savings account, but you can inside your retirement annuity. So what we've done, and we've done it recently for clients, remember, we're just humble stockbrokers, but we have a wealth division now that's coming up with all sorts of cool and interesting products for our clients. So what they've done is they've now taken a typical retirement annuity, and we've put a personal share portfolio inside it. Now, why is that a cool thing to do? Well, one, it's incredibly tax efficient, because remember, anything that you contribute to your RA, you get to take off your income. So this is ideally suited to kind of high income earners. If you're paying 45% tax to the government, and you can take off 350,000 rands worth of take your income down by 350,000 rand and get your tax rebate, that's, you don't need to do much in terms of performance to make that a great investment product. Now, the whole idea of setting this actually came through from the Section 12J sales pitches that we used to go and listen to. And they were all basically saying, hey, we've got all these little venture capital things. They're really rubbish, but wait, you get this big tax rebate, which will essentially drop into your performance. So if you're getting all this like kind of extra performance thanks to your tax rebate, hey, as long as these things survive, don't worry if they perform or not. All you really care about is getting your tax rebate. That's how those products are sold. We thought about it and said, yeah, you know what? Why not instead think about South African portfolios in the same way? We can generate, one, we know that these are good, like we can pick some pretty good companies in there, because one, you've got companies that are very undervalued in our market. There's some really great small and mid-cap companies that your big asset managers that typically have to manage inside RAs can't access. The likes of like a Distel or Adapt ITs, all the companies that international businesses are coming and buying up because they can see the value in the companies. We can put those in client portfolios inside a retirement wrapper. They're great businesses from an SA Inc. point of view, and you probably get a kick here if someone buys them out. And even if they don't really perform, something like storage, for example. So storage, I was having a look at it last night on a webinar with Simon Brown. Storage is an amazing company. It's a huge institutional ownership. The value of that company, that company is probably 50% undervalued if you compare it to UK peers. Yet it just can't re-rate. But the point is to put that in a portfolio, if you know that you're going to get a tax rebate anyway, and you wouldn't have an option of getting the tax rebate without owning something, and your other options are, just an expensive traditional asset management product that's going to whack you 3%, or maybe 1.5% to 2% fees, plus an advisor's fees, plus list spend. If you're in a life wrapper, you're going to pay like a massive upfront load. It's really complex and ugly fee structure. Hey, we can put in a simple personal share portfolio that is incredibly transparent, that's incredibly low cost. It's flexible enough to buy these little products. And now on top of everything, because it's in the pension wrapper, you get a protection from creditors, you get to avoid your estate duty, you get all the benefits of using retirement savings within South Africa. Why not use it? So that's what we created for clients. Now, as I said, the problem with it is because it's a personal share portfolio, you have the usual problems. We can only really do it with a million plus. We can do smaller accounts if you use what we're calling the starter portfolio, which is like an ETF-based thing. So if you haven't got an RA and you want to set one up for the first time, speak to one of our wealth managers. We don't, if you're very young, it might be better to keep, to pay the tax and actually, especially depending on your tax rate. If you're not a high income earner, if you're not using it for the tax rebate, maybe you rather keep the flexibility, pay the tax while your tax is low and you have a lower earning potential, and then only later in life start your RA when the tax rebate is going to be worth it and when you're closer to the retirement age. But if you're say 45 to 50 years old, you've only got 5 to 10 years left before this becomes totally flexible and you can invest it internationally. There is an argument to be made for an RA. So I like the idea of it. We're using this to create our local portfolios. We're using it as a vehicle for our local portfolios, which I think is pretty cool. Like I said, the guys that should look at this really high income guys, that really want to try and maximize their tax rebates. Remember your maximum deduction off your income that you can take is 350,000 or 27.5% of your income. And as I said, until you're 55, you've obviously got a lot of limits on what you can do. So it's not appropriate for everyone, but again, speak to one of our wealth managers. It's pretty cool what we can do inside those local wrappers. So now let's go back to international, which is basically normally done with post-tax money, and we just ship it offshore, and it's either put in a trust or it's done in your direct name, and we kind of do what we do overseas. So let's get back to that. So I just thought that was an interesting thing that we were chatting about last night that I'd share with you guys today. Okay, back to S&P 500. So last month, as you can see, we had that big sell-off in October, and as I said, we started pushing the button, and we started doing that. I did kind of sound a warning last month, just saying, S&P 500 does seem to have broken out that trend line. There is a little kiss goodbye. We were chatting when it was down there, as markets do, and the whole reason that we can try and time markets to an extent, but really what you want to do is you want to try and be fully invested as much as possible. The market just hooked straight up, and up it went. It's back above the trend line here. The VIX, which we thought might go and touch that line, just absolutely pulled down and is now pretty much sitting at an all-time low at about 15. So, strong month this month, and markets moving a lot higher. So here's your heat map for the month, and this is just looking at the S&P 500 and where it came from. And now remember that one of the reasons that we did hit the button hard and we started deploying is traditionally earnings seasons are very, very positive for stock markets. So we can see where this is kind of as a result of earnings season. We're going to go through the earnings in a little bit, but you can see kind of what's happened here. It's really good. Okay, one, semiconductors going berserk. So our Nvidia, which I said last month, which is it's been a good and a bad call. So we still hold Nvidia. We still got 5.4% of the portfolio Nvidia. It was getting to 10%. I said we have to cut this thing. It's running too hard. I know it's running hard, but we've got to trim it because you don't want that concentration risk in a specific stock. So we have started to trim Nvidia, but Nvidia is absolutely rocketing, and we're going to look at the company in a little bit more detail. Google, Microsoft, Apple, all the big tech stocks doing exceptionally well. Tesla. We're going to go through Tesla in the news section next, but Tesla, massive run up in Tesla, 55% for the month in Tesla. United Health, another one of our companies, up 16% for the month. Really, really strong month all around. Financial services struggling a little bit, so credit services under a little bit of pressure. We'll go through these results now as well. Oil and gas doing okay, but not nearly as well as big tech. As I said, that US market this month has just been propelled by its tech companies. Yeah, and kind of the more consumer defensive was also not performing as well because they're kind of defensive. When the markets are really pumping, defensive companies, they lag. They're low beta companies. Therefore, when markets, you want them in your portfolio, but you want them for when markets are not as robust as they have been over the last month. So what is kind of in the news, as I say, Tesla, 55%. So part of this big stock gain is, the Hertz deal. So Tesla is obviously selling a huge, fleet to Hertz. I think it's 100,000 vehicles, and that's just seen as accelerating the move to battery-powered electric vehicles. And Tesla's stock has soared, but it's Elon Musk. So Elon Musk came out, I think it was 2 days ago, and said, "Wait a minute, he hasn't actually signed a contract with Hertz." Kind of reminds me a little bit of the hey, we're going private at 420. He doesn't really care, about SEC regulators and how he communicates the markets. But yeah, just incredible run. Everyone going through the statistics of how wealthy Elon Musk is, but just goes to show that at the moment, markets are heated. And I put it on Twitter. I actually retweeted. It was a Duncan McLeod tweet, just showing the difference between the dot-com crash and where we are in tech valuation at the moment. These tech companies are getting scary. I mean, it's great if you're invested. And I know Viv's got a mini portfolio which he puts 10 super high-tech shares into. It's super speculative. It's doing amazing. Now, the problem is when we come back 5-10 years, how will that look if we go through a proper correction? You've got to also be sensible about the money that you deploy. So yes, Tesla is amazing. It's making a lot of cash, but it's very, very rich. What else happened this month? Facebook changed its name to Meta. Shipping costs have interestingly finally slumped. I've got a chart for you on that next, or in a couple of slides' time. So shipping costs coming down because the supply chain is still just an absolute mess. And we've already talked about the Fed has started its tapering program. So we are moving into a tighter monetary policy cycle. So that's kind of like the big news headlines. So what's happening in commodity markets at the moment? Commodities. Like I said, we are seeing a little bit of a drawdown. Remember, commodity prices, this is the Bloomberg and the Reuters commodity index. They are absolutely rushing higher. We've seen a slight moderation in commodities over the last couple of months, commodity prices starting to slump. The energy crisis that we're seeing in Europe seems to be resolving. We're getting supply out of Russia. Natural gas prices still up dramatically, but from kind of 400% up over the last year to only doubling. So energy prices are moderating. We're seeing that. So in a sense, the world will get back to normal. Economic systems can take punches like we've taken with coronavirus. It's no reason to go and buy gold and hide it under your bed. I have no problem with people buying gold, but you have it for other reasons. You definitely don't put your whole portfolio in that if you want to make any money. But trap, that's basically coal. You can see coal prices have moderated. The likes of Thungela, Exxaro, all the big coal, actually the dirty coal companies, having massive share price re-ratings because the coal prices have been coming down. If we look at softs, softs always lovely codes when you guys try and work out. That's just Reuters for you. So LRCC2, KCC2, these are both coffee contracts. So you can see price of coffee is up. Coffee is expensive. I mean, look at Starbucks later as well. But price of coffee is rocketing in the softs market. JRU is rubber. So you can see rubber is actually down. These two gold and silver, those are two sugar contracts, SBC1 and LSUC1. These are two sugar contracts. Sugar kind of like up 20% or so. So those are the kind of big groupings of the softs, but also no stopping in the price of coffee, but the rest kind of moderating. Okay, let's have a look now. Okay, so this is also the Baltic Dry Index. So this is what I talk about. So this is a measure of shipping costs, and you can see exactly what I'm talking about here. From absolute crazy supply chain issues where you literally couldn't get. So the index vaccine, so Cape-size Panamax and Supermax are different types of vessels. You basically you couldn't buy transport for love of money because it was just. That's what has happened to shipping prices. It's going absolutely through the roof. We've seen a massive collapse now. Part of it is China's regulatory tightening. It's one of the reasons commodity prices are coming off. They're just not shipping as much dry bulk anymore. and we've seen a big moderation in shipping prices, which is just an interesting trend that I thought I'd highlight for you guys. Currency markets. So if we have a look at currencies quickly, this is okay. So these are the latest figures. They come out on the 2nd of November. Every month, Reuters does a poll of all the big banks. It wasn't a massively in-depth poll. So normally we have more than 20 banks. It's only 21 to 27 banks that feed into the 1 year estimates. We always look at the 1 year estimates on rand dollar. Mainly because our portfolio is denominated in dollars. We have had requests to do pounds. I will, at some point, we'll do it in pounds and Aussie dollars and francs, and we'll give you guys all the information. But for now, also in the interest of time, we just do one currency, which is the dollar, still a reserve currency of the world. But we only had Nedbank was the only South African bank that made a contribution. Absa and Investec, they just put their old target prices in there, but they didn't contribute to this month's poll. Nedbank also pretty sticky. They think 1572 on a 12-month view. We're currently at 1528. We actually are. So right now we are at 1526. And it's kind of hovering there at the top of the channel. So I've done the technicals for you. As I said, our kind of range that we're looking at taking money in and out of the country for clients, we would be say bringing back now. So if you are looking to move out and you're looking to buy into our international portfolio, we would probably say, let's get it all ready. Let's get the account set up. But we would sit in what is an Investec CCM account for you if we're doing the transfer. You'll get your 4% and a bit interest. But we would just say, hey, let's just sit tight for a month or two, see if we can get a little bit of a recovery in our local currency. Remember, our currency is very, very correlated to commodity prices though as well. So I think there is a risk that this little horizontal trend breaks and that it moves up higher. Is there a risk that we're going back to 19 in the short term? I don't think so. Remember, this is a risk on risk off, affects our currency dramatically. We're seen as a very risky asset. So when the world panics, like when coronavirus happened, our currency gets sold off heavily. Now, that was an enormous economic shock that we've just gone through. I wouldn't think that we're going to move back there quickly unless we get another enormous economic shock. So for now, I would say, safely, I'm personally, we're bringing back currency into the country at the moment. 1440 to 1480 will be shipping currency out again. That's kind of where we've got our targets. We've got a lot of client orders stacked up there, between 1440. We've got one client that's very optimistically looking at 1390 and waiting for that. I'm starting to worry that you're not going to get back to the bottom of that range. Goldman Sachs, however, says 1280 is still on the cards. They haven't changed their view. Morgan Stanley, they've become a little bit more bullish, but Julius Baer is becoming bearish. So Julius Baer sits at the outside, Goldman Sachs sits at the bottom. Julius Baer sits as the most bearish bank. And that gives you kind of a sense of a range with currency. That's the outside range. So if you're thinking that in the next 12 months, the currency is going to be 17, you are more bearish than the most bearish investment bank in the world. If you think it's going to be stronger than 1280, I don't think that there's many people that believe that, which means the market's probably going to show you up and go there. But no one is more optimistic than Goldman Sachs. So the idea of hoping that the currency goes to 11 Rand, I think is way too optimistic. That's kind of the range that you're working in at the moment. Personally, because we do this all the time, we're saying 1440 to 1550 is kind of, we're at the top of the range now. Time to bring currency back into the country if you earn money overseas. Okay, global managed portfolio. How did we do? Yes, I said really, really robust month. 5.2% up for the month. In dollar terms, and that was really a recovery of the 4.6% drop that we took the month before. Remember, we are always going to be correlated to markets to some extent. Remember, this is just a screenshot of the system. We put $100,000 into the portfolio about 5 years ago. We're up 120% over the period. Unfortunately, the system doesn't allow me to benchmark against MSCI World, which is our official benchmark. Because we hold stocks in Europe and China, etc. But Wall Street 30 is kind of just another benchmark. It's up about 103% over the period, so you can kind of see the differential there. But it's not entirely fair because we have got a global mandate. Our best three performing stocks over the history of the portfolio are the three best performing stocks for the month, believe it or not, because they're the three biggest positions that we hold. Well, not three biggest positions, but they are three large positions that we hold. Nvidia, Amazon, and Alphabet. Big gainers on the portfolio. Losers on the portfolio is Schlumberger, which is actually a sold stock, so that will stay on there. International Business Machines, which is IBM. We'll talk about that in a second, and Walgreen Boots Alliance. One of my stable stocks that hasn't worked out. But those are the losers on the portfolio versus the winners. Overall, as I said, 120% up, 5% thing. So you put in $100,000, you're now on about 120,000 rand, $120,000 over 5 years. That's what the performances look like. You can see the performance stats on the bottom right-hand side there. We're up 19.9% in dollar terms for the year. That's after all costs. All of these figures are after costs. But the three big gainers and the three big losers for this month have been Nvidia, Alphabet, and Nike. Oh, sorry, it's not. It's Amazon and Nike. Sorry, no, it's not the same. So Nvidia, Alphabet, and Nike are the big losers. And Visa, IBM, and Starbucks are the three big monthly. Sorry, it's been a long week. 4-day weeks are tough. Nvidia, Alphabet, Nike are our biggest gainers for the month. Visa, IBM, and Starbucks are the biggest losers for the month. So let's have a look at what happened on them. Sorry, I don't know why I read Amazon. I did it on here as well. So I'm actually going to look at Amazon instead of Nike as the gainer. But Nvidia. Okay, so Nvidia, absolutely, like I said, absolutely stellar results. Remember, we're going through a chip shortage at the moment. So they released earnings. Earnings just beat, but when you're looking at stocks like Nvidia and chip makers and tech stocks, earnings are less important than revenue. So it was a beat on both top line and bottom line. Earnings coming at 1.04 versus 1.01. Revenue also beat on both sides. It's got a whole lot of new analyst upgrades. Bank of America just reiterated its buy recommendation on the stock. That sent the stock up 12% just last night. This thing is on absolute fire. Now, we bought it years ago, so it's a massive winner in the portfolio. But yeah, as I said, I've had to kind of tone it down. It's just becoming too much of the portfolio. And if things really start to fall apart for the company, which it really doesn't look like it's going to, but if you never know, we live in an uncertain world. I don't want you to dump 10%, 15% of your portfolio if it turns out that it's Enron or the management has been siphoning money or whatever. I don't think that's the case. It's a very well covered stock. It's a massive US company, so I doubt it, but it's not. It's just it's practicality that has made us have to downweight it. It's back to 5.4% of the portfolio, the total portfolio. Amazing numbers. Strong graphic card sales. They've got specialist graphic cards as well, so they look at obviously this PC that I'm speaking to you on is running on an Nvidia graphics card. It's my 3080, but looking at it, it's not just gaming graphics cards. It's an artificial intelligence. They have application of artificial intelligence. They have specific crypto mining cards as well. Remember when we first got into this was when Bitcoin went through its first big wobble. Nvidia stock dropped because of that. Because crypto fell, and crypto is a very uncertain market. So one of the reasons that I have to justify toning down our exposure to Nvidia, that it is in a sense linked to what happens to crypto. And if you've got a more bearish view on crypto longer term, having a massive portion of your portfolio in Nvidia is probably not a good idea, but it's a good company. So strong graphic card sales, great chips, everything good. Stock is absolutely pumping over the last month. One of the biggest gainers in the portfolio. Amazon, so Amazon interestingly badly missed on earnings and revenue and gave disappointing guidance for the quarter. So earnings are a huge miss, 6.12 versus 8.92. Revenue also a miss, but not great. Now, it just wasn't what analysts were expecting. I think it's with the lockdowns, lifting a little bit. People are literally returning to physical stores. So you're getting a lot of people moving back into real world. I didn't know they still existed. But yeah, I think our view at the moment is that you've got to be a little bit cautious of Amazon, but it's a business that probably can do more than something like Google, because the retail market is just so much larger. And what they're doing in terms of their supply chains, I mean, I actually ordered stuff off Amazon a little while ago. Amazon delivers to South Africa quicker than Takealot delivers to South Africa. And you literally watch DHL bring it to you through ships from the US to Amsterdam. So you watch the whole thing. It's quicker than we can deliver it locally. So yeah, incredible business, of course. I mean, most people know Amazon, but again, the way that the world is operating is changing, and I think our view on retail is that you're still going to have a place for physical stores. They're going to be experience stores that are the product is delivered internationally. So, from my point of view, you're going to go to a gym. And it's going to be a gym and a workout and sports ground where you're going to go play sport. And then you're going to go and buy your cricket bats or your sporting gear or your running shirts or whatever it is. Because that gym will have a brand, and those brands will be representative. That gym will have a partnership with Nike, and it'll be this experience that you go to, and because you want to be part of that community, you'll buy online. It's the same as what they're doing with hair salons, and so the hair salon gives you this pampering and treatment, and it's like a beauty spa that you go to, and then all their products are available, and they essentially get sold to you. And oh yes, we're massaging you with this oil, and it's available on our online store. That's how retail is going to change. Your physical stores are going to be experiences that you go to that create the community and the brand, and the rest will be delivered digitally. Amazon, more of a marketplace. So yeah, maybe the world will change with Amazon, but yes, still a great business, still absolutely dominant. Can't argue with Jeff Bezos and what he's done. So it's still worth a position in the portfolio. Absolutely not thinking about selling it. Google, when we ran, remember, a lot of our shares are selected through quantitative rankings. Google continually comes up as the best ranked stock that we have. While I look at it from a layman's point of view, and I look at how much of its business is its advertising revenue. Now, its total revenue was 65 billion. Of that, advertising revenue was 53 billion. So advertising is still where Google makes its money. Now, the advertising world is smaller than the retail world. The value of all the goods and services and the margin you can make on goods, and so all the goods and services that translate across the world is far greater than the advertising. Yet Google and Amazon are similar sized companies. So in that way, that's how I think about it. But yet, from a quant point of view, Google is just super. You can see from an earnings point of view, a massive beat on earnings per share, a big beat on revenue as well. YouTube advertising, that came in a little bit softer than expected, but I think you've got to remember Google is valued as a tech stock. So if you look at the cloud is only 4.9 billion. We call it 5 billion of its revenue of 65. And I mean, cloud, there's huge applications there. The profit of Google is a tech company that you're not just looking at the advertising revenue. You kind of the same way as you can't look at Tesla as a car company. Tesla is also a tech company that maybe will have humanoid robots running around, 75 kilogram humanoid robots that are using its artificial intelligence to run around the streets because they've got all the data from driving their fleet of Tesla cars. Now, that's what's priced into Tesla. Google, to an extent, is also, it's Waymo, it's all the things that Google does with the information that Google generates through search. It's Google Maps. It's all of those things that don't have a tangible monetary value on them in terms of what you're earning, but do have to be accounted for in some way, because they just give Google such incredible capability to maybe not monetize it in the short term, but to create products that we've just never seen before. So does Google stay in the portfolio? Google stays in the portfolio. There's no problem after looking at the Google earnings this quarter. We are happy to leave Google in. Okay, so Visa was one of the big drops that we saw. So Visa, IBM, and Starbucks. These are companies that were under a little bit of pressure. So Visa actually, it topped so basically earnings were good in Visa, but they gave it a little bit more disappointing outlook, and that's why the stock fell back a little bit. Revenue, revenue beat expectations, earnings beat expectations as well. I've got the numbers up for there if you're interested. Number of transactions processed, 11.7% up. It's good. The business is solid. Visa, it's kind of one of the big blue chips that benefits, will benefit as international travel, as people go out and spend, as economies get back to normal. Visa will be a beneficiary of this. Are we all going to move to decentralized money, and is that going to be the end of Visa because we're all going to be paying with through the blockchain? I don't think so. I don't see it. Visa as well, they're using blockchain technology as already. They've got crypto cards involved at Visa as well. Total payment volumes up 8.7% to 2.2 trillion processed. Incredible company, still worth a spot in the portfolio. IBM has been a perpetual laggard. It's been a very, very disappointing stock pick in the portfolio. Yet we reviewed it recently in our investment committee meetings. So it's kind of earnings per share came in, slight beat on earnings, slight miss on revenue, not particularly exciting. Stock got punished on the back of the miss. Also, CEO came out with a very, very dour, like, we're really sorry that we missed on our expectations. It wasn't great. But IBM at the same time is incredibly cheap. It's not one of the popular tech stocks yet. It is exposed to the very exciting markets. They're focused now. So what's happening on the stock as well, and you would have seen in your portfolio, we've held through. We kind of looked at it and said, should we just this is when we looked at it before the corporate action. We kind of said, should we just sell IBM because we already want to get an odd lot? And, we don't want. Do we really want Kyndryl, which is going to be spun out of IBM? Do we want this in investor portfolios? Should we just exit the stock and look for something better because it hasn't performed for us in a long time? And we kind of reviewed it. We like the businesses that they're into. Remember, IBM is kind of like a second tier tech stock. It used to be Big Blue, used to be one of the super exciting ones, but their systems are so integrated into the way that the world operates. They've got Watson, their artificial intelligence, which is in pharmaceutical systems, it's in at least hospital systems. It's a very exciting business that just because it doesn't have the kind of big earnings and revenue growth profiles that some of the other tech stocks have, it commands a very low multiple. Now, for us, this is almost like it's a weird value tech stock. So with our view that markets at the moment are a little bit heated in the growth space, and because we've got high inflation and fiscal stimulus programs coming in, we believe that value stocks will turn around. We've decided to keep IBM in the portfolio. What that has resulted in is that you'll see the Kyndryl spin out. That actually happened, I think it happened today or yesterday, but it's in portfolios at the moment. So I don't know if it arrived this morning or it arrived yesterday morning. I didn't look at my portfolio yesterday morning, but yeah, you've got Kyndryl in your portfolio. It's essentially they managed infrastructure business. They want to focus on hybrid cloud and AI, and they so they're just letting that sit as a separate management team. They've still got a 20% stake. It's still kind of part of IBM. It was a 5-to-1 unbundling. So for every 5 IBM shares that you have, you get 1 Kyndryl share. It's in your portfolio now. We're going to hang on to it for a little bit. See, we generally don't sell out of unbundlings very quickly. I like to see markets get a fair price in the stock before we do anything, unless we have a very, very strong view on getting rid of it. So we will probably be sitting on it for a little bit. Finally, Starbucks, running over time. We're on time now, so I'll just wrap up quickly after this. But Starbucks same-store sales increased 22% for the quarter. Strong loyalty program, up 28%, very, very key. Everything that we want to see in Starbucks is them creating communities and building the community. That's how retail, as I was saying on Amazon, that's how we believe retail is going to work in future. That loyalty program is key. That's why I've put it in there. Earnings and revenue didn't match expectations. That's why the stock came off a little bit this month. They earned $1 a share versus 99 cents, so they basically came in line. But when it comes to earnings, everyone knows there's whisper numbers out there. You're expected to beat. So whatever the official earning expectation is, it's always a little bit more than that. They came in, 1 cent ahead in earnings expectations, and they slightly missed on their revenue expectations. But I thought, that looking through the results, I thought it was good. I really didn't have any issues with it. There was some disappointing sales growth in China. We know China is under pressure. Remember, this is a stock that is being hit by the pandemic as well. I mean, you can't just catch up in sales, of coffee. If you couldn't get your Starbucks coffee on the way to work, this would impact Starbucks. But they're looking at it and saying peak hours, they're back to pre-pandemic levels. So the business looks like it's going to be robust, excuse the pun, going forward. And remember, they hedge their coffee exposure. So those higher coffee prices don't affect Starbucks weirdly anyway. But yeah, otherwise that's that. How did the portfolio do? Like I said, you've seen it all tick up. This is the actual benchmark, which is the MSCI World. Good. We've had a tough 4 months. When I say tough 4 months, we've been kind of matching the market, but we've been like a couple of basis points behind each month. So I've had, you can see like there's no big differentials like we had over COVID, where COVID the market had a huge collapse and we had almost no collapse. It's been like a little lag for the last 4 months, which is annoying me a little bit, but it's also because we're sitting a little bit heavier in cash because we're a little bit concerned just about overall valuations. But yeah, it's one of those things that swings and roundabouts. So it's still very happy. I haven't got the volatility chart up yet because we haven't produced it for this month. But as you'll see, our performance when you risk weight our performance is far above our benchmark. So in risk weighted terms, we are significantly better. And as I said, we've done 20% for the year in dollars. I'm happy with the performance, still very happy with the portfolio. You guys probably know the investment philosophy already, but I mean, we have quite a broad international mandate, and we can invest in a lot of different types of shares, listed securities, ADRs. We can even invest in ETFs if we choose to, but generally what we do is it is a stock portfolio that we manage internationally for clients, and it's really designed to hold nest egg portfolio, something, your little go bag overseas, that you want to stick that is non-correlated to the South African markets to build up some assets. It's normally properly externalized, so if you did ever immigrate, those funds would be available for you, and we are happy to keep on managing them as best we can. The performance has been so far above anything that you could have had in a South African product. We've been very lucky, and I think part of that is just the fundamental view that we've had on international markets versus South Africa. We think the South African economy is weak, and we think without that tax rebate, you're going to struggle to make above average returns. It is obviously an equity-based product, so it will always be considered high risk. Moderate risk, we look at the structures, where we can give you some element of capital protection. Low risk, we would put you in our fixed deposits and CCM accounts. We also have some nice structures that we're creating again in Luxembourg for another client, which are kind of 5% dollar coupons with big capital protection. They're kind of auto call products that we're building now, but those are medium risk products. If you want to invest, I say the minimum is about $50,000. That's probably reasonable. We do take clients for about $30,000, but if you can get above $50,000, that's probably the best value to start with. Yep. Okay. Transfer the currency. If you want to get an account, you literally just go to randswiss.com/account, pick manage portfolio, fill in your details. One of our reps will contact you and assist you with getting set up. Thank you everyone for listening. I hope it was valuable. And that's the end of the presentation, but I will answer questions now for a little bit, just run through the Q&A. But yeah, I'm going to try and keep this to an hour in the future. Oh, okay, a lot of questions. Okay, I'm going to try and go through as many as I can. And the Q&A questions. Okay, cool. Okay, can you add Australia? Okay, so we said yes, 100%. I'll make a note to add Australian performance to the chart for next time. So Oz performance, I think that's a great suggestion. Can the government grab your TFSA? Well, the government can grab anything. It's the government, they have soldiers. But will the government grab your TFSA? Almost definitely not. So I think the government, and it depends what you mean by grab as well. So I mean, we were looking at retail savings bonds versus a structure versus money market accounts for a client 2 days ago. And remember, if the government doesn't asset grab, I mean, there's histories of these things. I mean, Cyprus did, but they grab cash above a certain value. There's no way they're going to target low-income earners. So there's no way they want to target the electorate, the majority of people, and that is who tax-free savings accounts were designed for. Now, it is obviously open to everyone. So, like I said, the problem is you can only put 36,000 Rand a year into tax-free savings accounts. It's not designed for high net worth people to go and like the guys were using the Section 12Js, where they were taking these things, venture capital funding, and they were basically just going, those businesses are going to do nothing, but you're going to get a 45% tax rebate, so your return is going to be great. Now, that's not like, I mean, yes, you can apply the same logic to a TFSA. That's why if you're a high income earner, if you're anyone, you want a TFSA, because I mean, one, TFSAs are funded with post-tax money, not pre-tax money, but essentially, like, all that capital and growth inside there, I mean, your capital gains liability is going to be serious. If you invest outside of a TFSA versus in a TFSA, the TFSA will do so much better, because no tax on dividends, no tax on interest, no tax on your capital gains. You go and stick it in a nice managed portfolio, like over a long period of time with an equity base. I mean, if you've got a 30, 40, 50-year time horizon still on a TFSA, if you're doing it for your kids, I mean, we worked it out that if you do one contribution to a TFSA for your kids when they're born, just one, so 36 grand in once, and you left it at a normal equity market growth rate, by the time they retire, if they were retiring at 60, that TFSA would give them 20,000 Rand a month in tomorrow's money, inflation-adjusted money, for the rest of their lives. I mean, you can essentially sort out their retirement with one contribution. I mean, it's a phenomenal product. Now, will the government grab it? Who knows? It's the government, but will they target a product that isn't designed for super wealthy people? Are they going to target a product that is the entire thing is designed as broad-based, savings tool? I doubt it. I really, really doubt it. Could the rules change? Yes. Could they start looking at how much is being saved in there and how much tax they're losing, and then say, oh, listen, we're going to have to discontinue it? Maybe. But again, remember that these TFSAs are based on best practices internationally. I don't see it. I think there's much lower hanging fruit if they're going to go after retirement savings. So much lower hanging fruit than TFSAs. I would still say a TFSA is safe. And anyway, the TFSA is only one component of your overall wealth building strategies. So yes, I don't think that they're going to zuck it. COP26, Britain gave SA money to try and stop our fossil fuel industry. I was like, okay, I don't know, it's not really a question, but there's an interesting point on that. If you read Dambisa Moyo's Dead Aim, when governments give other countries money, it often stifles their innovation themselves. So I don't know. Interesting one. Interesting. I didn't see that, but yeah, read a book there. It's not a skinny book. It's really interesting. What's your view on crypto? What is my view on crypto? I'll come back to that. Okay, so if you have funds offshore, how do you put funds into a global portfolio? So it's super simple. So the global portfolio can run in just about any structure. So if you've got funds in a trust, you can manage within your trust. If you have funds in an offshore company that's held by a trust, you can manage in the name of the company. If you want to do it in your personal name, we can set up offshore accounts and you literally just transfer the funds into the account. As long as the account is in the same, we can't take third-party payments into the portfolio. It's just a money laundering thing. So as long as the funds, your international funds, are sitting in let's say they're sitting in a Guernsey or Jersey bank account, and the bank account is in your name, we set up the account, you transfer it into the securities broking account. As long as it's going from your name to your name, no problem at all. we can implement the funds. It's that simple. It never, if your funds are correctly externalized already, there's no problem just transferring it straight into the portfolios. It never has to come back to South Africa. These are fully offshore managed portfolios. There's no link back to South Africa whatsoever. Okay, what's my view on crypto? Crypto is interesting. So it's interesting. I don't know my view on crypto. I don't think you can value crypto. I don't know how to value crypto. I don't know my view on crypto. So I own a little bit of crypto in my ledger, like my hard wallet. I've played with the systems. I've looked at it, but it's like, as a serious investment for clients, it's super speculative, because one, I don't know how to value it, and it kind of looks like a massive bubble to me. I don't get it, to be honest. I mean, I understand the idea behind, a decentralized money system. I think it's great. I don't think it'll ever be allowed. I don't think governments who have the guns are ever going to permit it to operate in the fashion that so many people have bought into the idea that it is going to operate. I think the way that it's marketed is disgusting, and I think that a lot of the bubble that's being created, in my opinion, it is a bubble, is being created by very poor marketing and investors with a very low understanding of what they're getting involved in. But at the same time, I can't argue with the returns. I mean, I'll give you an example. So we had our clients. So the guys it's two young guys, two brothers. They put 50,000 Rand into the crypto markets in 2016. They've been looking at early stage projects. They've been doing all sorts of things, and they put this cash in, 50 grand. And I've seen their Binance accounts, like they've got 20 and 23 million each from 50 grand. Like, it's insane what they've managed to do with it. And so how can I argue with that? You know what I mean? It's like, I can't look at that and say, oh no, crypto is rubbish. Only an idiot would invest in crypto. That's crazy. I can't say that, because it's incredible what they've managed to generate. And I think, it's a very exciting place, but I think performance also fuels its own speculative bubble as well. So I think it's going to be fascinating how it plays out eventually. And I just don't know. I mean, I still don't understand it. I don't understand where it gets its value from, because is it scarcity? It's not scarcity, let's face it, because you can create as many. Yes, a single crypto contract might have scarcity, but there's no scarcity if you can create an infinite amount of differently named crypto contracts that do exactly the same thing. So it's basically just mass common acceptance of one scarce contract. But at the same time, it also doesn't do anything. It actually just consumes energy. It's so different from a stock, where there's actually real products and services being created by that capital. So it's difficult to allocate capital to it. But I don't know. Like I said, I don't think I'm qualified to answer the question. So, and I know I'm probably just annoyed all the crypto guys out there. But yeah, like I said, I hold a bit of crypto. Like, you can trade crypto on our systems, but will it become an international payment system? Will it replace central banking? Will governments ever accept it as a payment for tax? I don't know. Like, does it process payments better than the existing system? Because I think this is my view of crypto. Whenever a system is over-regulated, a black market is created. So when there was prohibition in the US, what happened? You had bootleggers. So you ban alcohol sales, and immediately speakeasies are created. Because when there's a real demand for something, and when there's a need for something that can be serviced that regulation is preventing, a black market must be created. Now, that seems to me why crypto has been created, why crypto exists, because finance as it stands at the moment is heavily over-regulated. And I'm not saying that there should be no regulation, but it's just too regulated. It's not allowing people to move. With the clampdown that we've seen in AML, with FATF, with all the things that we've now got to comply with as financial market professionals, it's almost become impossible to move. And yet the demand for this free flow of capital across borders, into anonymous transactions into products and services, not just to buy hitmen and drugs and whatever else you can buy with crypto, but the idea of your finances and the work that you've done, and when I say the work that you have, if you do work and you receive money for that money represents the work and the productivity that you've created. Why should that be public knowledge of governments? I understand the secrecy aspect of it as well. Like, I think that there's a real demand for that. Now, because there's this over-regulation, those needs still exist, and that's why crypto has come into existence to service those needs. And the only real solution to getting rid of crypto, though, will be the way that they got rid of speakeasies, which is to loosen up regulation, and to kind of to combine with it. So the same way as alcohol and tobacco is now, yes, it's still heavily taxed, but it's now part of the formal system rather than just banned and outside the system. It's something that, like, if you read any economics textbooks and they look at the American war on drugs, for example, they say the idea of having illegal drugs is crazy. It's absolutely, from an economic point of view, it's mad. You should have all drugs because there's clearly a demand. That's why there's a black market for the drug, cocaine and heroin and all of that. That's why that exists, is because it's overregulated, but it's something that people will do whether the regulation exists or not. So the best way to actually do it is make it legal and then tax it, because then you can at least control it, because otherwise it's uncontrollable. And I feel crypto is in the same league as that they can't control it. So they need to accept it. If you want to put it that way as well. So a different view as well. Cool. Thanks for you. Obviously, I went on about that too long. Cool. Okay. When you say you limit the exposure to Nvidia to 25%, do you use the excess trim or okay? Do you use the excess trimmed in existing holdings? Do you use it? Oh no. So new opportunities. Yeah. So we don't. Okay. So it's a great question, and just understand how a personal share portfolio works. So when I trim, let's say Nvidia is going to 10% of the portfolio, I trim out of Nvidia so that I've got 5% of Nvidia left. Instead, I won't distribute that across them, because that's going to create transaction costs in the portfolio, because these are personal share portfolios. So we would then redeploy it into a new position, which is, at the moment, we're sitting a little bit heavier in cash. And we talked about it in last month's meeting. We redeployed it into GM. So we got GM at $48, $49 a share, somewhere around that. And again, it's a very, we've kind of gone out of, everyone is, remember financial markets pricing the future. Just, you've always got to remember that when you're dealing with financial markets. So we've moved on. Everyone knows that there's a chip shortage. Everyone is pricing these chip makers like to perfection. Nvidia is expensive. AMD is expensive. Qualcomm is expensive, Broadcom is expensive. They're all expensive. Semiconductors are expensive at the moment. What is cheap is vehicles. Ford, GM, cheap. VW, cheap. Now, like cheap stocks versus expensive stocks. Expensive for a reason, cheap for a reason, sure. But as I said, based on our view, we are slowly starting to move towards a more value slant. So that's why we deployed into General Motors. And for the first month, it looked awesome. General Motors was up 20% from where we bought it, and Nvidia had collapsed. Also about 15-16%. So I was like, wow, we're 30% ahead because of our switch. But Nvidia is now reversed and shot the lights out. Actually, it's still up, but yeah, Nvidia is still performing a lot better. So, timing hasn't been great, but you have to start these things, because, like I said, I'm not going to push the red button. It's about a slow transformation, and one of the real reasons for it was just the concentration risk that was building with that Nvidia position. Thanks, Gary. Thanks for the market update. Crypto view. Cool. Guys, I'm going to leave it there. It is now well past the hour, and I've got another meeting. But thank you, everyone, for joining. I hope it was useful. Oh, sorry. Another question here. Sorry, let me do these ones. I'll do one more question. Okay. If SA interest rates rise, how will it affect bond yields and capital? Okay, I've got these. Okay. So interest rates are generally very, very negative for. Okay, so it's interesting. So it depends on the bond that you're looking at, and it also and it depends what you mean by capital as well. But essentially, like when interest rates rise, remember that So it depends. It depends what interest rates you're talking about. So when the central bank sets a repo rate and the repo rate increases, that generally through the discount window that makes bank financing more expensive. But remember, like our general bond rates are actually floating bond rates. That's why our repo rate will affect things like current accounts, lending rates on bonds, all of that kind of thing, and that feeds into the economy. But if you're just going and buying like a South African government bond, that's a market-based interest rate. That's why you'll get an 8-9% yield on those bonds, because those bonds are taking into account the risk of the issuer. So if it's a government bond, it's taking into account the risk of South Africa as an issuer. If it's a corporate bond, it's taking on the risk of default of that bank, at least that company not being able to pay back its interest. And then obviously the duration of the bond all goes into the coupon and how big that coupon is going to be. But those are set in the market. Those aren't set like lending rates in the repo rate. So it depends on a lot of things. So one, it depends what yield you're talking about. It depends on it depends on a lot of things. But generally, what will happen is it should increase bond yields, because think about it this way. You're always looking at your weighted average cost of capital, so your WACC. So when interest rates increase, so when the repo rate increases, banks have to increase everything, because through the discount window, they've got to now lend at higher rates. So when they're lending to a company, the company's interest rate, when it refinances its debt, that's going to be refinanced at a higher level as well. And that whole thing feeds into the market and makes the company in a more difficult cash position as well, because now suddenly the company has high interest payments. So generally what that would do is it should lift bond yields as well. If the repo rate was a 15%, bond yields would be much higher than where they are now. But it's not a direct mechanism, if you want to put it that way. Like I said, bond yields are set in a floating market. Cool, guys, I'm going to leave it at that. I hope that answered the question. I hope you enjoyed the session. If you do, you can always pop me an email. Just send me the email to info@RandSwiss. We will put the slides up with the presentation. We'll circulate to the presentation for you guys. I want to go and check the slides, or I don't know what you want to do with it. But thank you everyone for joining. And I will chat. I think we're doing a property webinar later this month. So we're going to look at 3 property stocks, and then we'll do the final one of the year, which is the December one. Beginning of December, before we wrap up presentations for the year. Thanks everyone for joining. I'll see you next time.